Hi everyone, Q here from Hyperstocks. Thank you for coming on board and thank you for visiting the channel. Today we're going to talk about the current state of the markets, the last year we've had, and the outlook for 2022, along with some of my favorite names for the next year. So, first things first, the beginning of the year this year has been a little bit rockier than usual. January is typically a very strong month for the stock market. However, you can see that since the start of the year, right around this time, we started sloping down. So it's not really going accordingly to plan per se, because there is something on the stock market that's called the January effect or the January boom. This is a time in which stocks are supposed to soar, but we're not really seeing that happen. However, there is a misconception about where the money is going and what's been focused on and how you should shift your focus going into the new year. So a lot of people are looking at, their common stocks like the Nvidias, the Apples. So let's take Apple for an example. When we look at the last year, obviously Apple has had a phenomenal performance. I mean, this thing has not stopped. A massive move. It went through a split, I believe, in the last 2 years, and it gained this much amount. But when truly analyzing the stock market and looking at all these runners that saw a massive year, you're going to realize that eventually what happens is people start taking profits. And this typically happens right around the beginning of the year, especially after a massive rally, as such that large cap technology stocks have seen. So when we're focused on large cap technology, let's take a look at the QQQ. So triple Q index measures the large cap techs, and you can see that it had a phenomenal year. I mean, we were bullish all year. We're actually been bullish for the last 2 years if we really look at things, and you can see that this market gain and this market cycle has to come to somewhat of a slowdown eventually. Capital will come out of this. So recently we saw that bond yields started to rise. This put more pressure on technology stocks because now there's money to put there's another place to put your capital in. Therefore, we saw money coming out of the triple Qs, saw money coming out of the technology stocks, but it's only going to lead it into putting money into other areas. These are areas that are typically lagging behind. And what lagged behind last year the most is going to be financials. So when we're looking at financials, we can see that the 1 year for Bank of America looks a little bit less strong than the technology stocks. So when we're comparing Bank of America, for example, this is Bank of America since the crash or the pandemic crash, and you see that it's not much higher above the pre-market level or the pre-crash levels that we saw when COVID hit. But when we compare that over to something like Apple, we see that Apple is much stronger. It had a much larger rally since that crash. And therefore, we're going to see money coming out of the large caps that have already ran their course. And we're going to see money flowing into more stocks that have not been touched in a while. So you get your 3M, for example, a company that brings in $6 billion a year in profits. Yet they haven't even broken out. Look how low they're trading on the year. They haven't even seen the light of day. So money is going to move. Wall Street doesn't like to leave its money in one place. Its main idea is we're going to ride a rally for as much as we can. We're going to capitalize on that rally, and then we're going to move our money into stocks that have not really seen those massive breakouts or massive rallies. So you're seeing those stocks that are still great names, but I have not seen that large upside move yet. So to bring it really home, we're going to actually look for the long term. So let's do 2022. So if we're looking at the top twicks of 2022, first we have AMD. First we have Amazon. The reason why tech is still is still holding the leadership on this board or of my top picks for 2022 is because at the end of the day, we can look at all these other companies and we can see what kind of innovation they're going to get into. But in reality, tech is still leading the boards in terms of profits and revenue, which is why we think the stock market is not crashing. It's just going through a correction. A correction for Apple, for Microsoft, for Google, and for Facebook is well overdue. I mean, the amount of gain or market share that they've gained, they're due for a correction, which leads us to the point that the first half of 2022, or maybe the first quarter, we're going to see technology companies come down. We're going to see them slow down. We're going to see them start moving sideways, and money's going to go into your Boeings and your larger cap non-tech stocks. Consumer cyclical stocks, such as leisure stocks as well. These companies have been beaten down since the pandemic lows. Now, although it doesn't seem like it with Omicron, but we're still coming out of a pandemic, and there's still going to be plenty of opportunity in the leisure sector, consumer cyclicals, and companies that have not really been as popular in the stock market. So going into 2020, your goal should be focusing on the companies that are still on the lows and not on the highs, until the companies that were on the highs of 2021, like technology stocks, come down to more attractive lows. And that is going to happen in the next 3 to 6 months, that you're going to see your Apple finally stabilize. They're going to come down. They'll likely come down to retest the 140 to 150 level at some point, and this will be an opportunity to sweep them up at a lower price. Whereas if you're going for a stock like Boeing, it's already at a very low and attractive price. You got to remember, these guys are still leading the boards in airline machinery, so they're still going to be able to perform. They're still a trusted company, and they're lower, although they're not on my list this year. This is just an example. So going through the top picks of 2022, the top picks are going to be Amazon. So Amazon, fantastic company. Companies bringing in $70 billion in profits. A phenomenal company. Financials are outstanding. There's a very obvious reason why Amazon is a pick. When we look at 2021 and the performance that Amazon had in 2021, we can see that the stock is actually flat. So if you picked up Amazon at the beginning of 2021 and are holding it still, you're not up much. You're up like 1 to 2%, and that's about it. So very, very shocking performance when we're looking at Amazon per se, because Amazon should be performing at a much better level. If you really look at the numbers and you crunch the numbers, it should have rallied just like Google rallied. It should have rallied just like Apple rallied. But I want to show you something. When we're looking at Apple, notice how long Apple stayed in a flat position for 2021 before, just like it was coming down, it suddenly saw a surge of buyers that led it to that rally. And this is exactly, pay attention to this pattern right over here. This is exactly the pattern we're seeing from Amazon right over here. So it's coming down and it's going to rally. So apart from the amazing fundamentals and financial analysis that Amazon has, the technical analysis is also spelling a massive buying opportunity. And this will start to gain market share in the second quarter of 2022, because it's not going to stay at these lows. Amazon will simply not stay. They have a massive cloud business. Their AWS is only growing, and this is going to be a winning company in the future. This is my number one top pick for this year. Obviously your Apple would be next, but not at these highs. Not at these highs. It may look enticing at these highs, but I want to add Apple at the 50-day moving average, at the 100-day moving average, at the 200-day moving average. And you may think it's impossible. Everybody wants Apple when it's around $180, but nobody wants Apple when it's back at 165 after this rally. So that's the thing that you got to really hammer in your head. When you take on a company like Apple or Amazon or Facebook or AMD or Intel, these companies are far too healthy to not pick up when there is an opportunity such as this at the 100-day moving average. Notice how it came down and then instantly took off from the 100-day moving average, because this is an obvious buying dip for many investors. So these are the lines that investors professionally use to add in these long-term dips. So when Apple gets to that 100-day moving average, or that 50-day moving average per se, don't hesitate to add, but leave capital on board. That way you can add more if it gives you to that 100-day moving average, and just buy and forget. This is a company in which is going to perform over the next 2-3 years. The stock market, more money has been lost in people trying to predict the stock market, the crash of the stock market, than there has been money made. So don't try to predict the stock market. No matter what's happening in the world, yes, there may be short-term turmoil, but in reality, the numbers are not slowing down for these companies. I mean, they're posting massive, massive growth, and they're still going to grow as new opportunities come in new technology and electric vehicles, in Apple headsets or virtual reality sets. This is just an example from Apple. Microsoft getting into the metaverse, that's also a massive opportunity. So that brings us to our next topic, which is Microsoft. All of these have 4.5 company financials. This is based on the following. This is based on their potential in their specific sector, their long-term outlook, their debt to asset ratio, so how much debt they have on board versus how many assets they have to cover. We always want a positive asset to debt ratio. So we want assets to be higher than debt. Obviously, a lot of these companies have 3-to-1 or 2-to-1 asset to debt ratio. So fantastic ratios. Google earns our top company financial rating. So they earned a 5, which is the best you can earn. Amazon, I would say, earned a 4.5 due to the debt to asset ratio, but Google actually has a fantastic balance sheet. And this company is going to compete. Nobody's going to compete with Google, not for a long time at least. There's a very good chance that these guys will continue to go. But when do you add? So Google is trading below the 100-day moving average, but notice that when it comes to Google's 100-day moving average, it's very close. It rides very close to all its other moving averages. And when it does stir too far, when the stock stirs too far, it corrects itself back down to that 100-day moving average. So this leaves you to question, if Apple's 100-day moving average is so much lower, why is Google's, riding so tightly? And that's because it moves in a tighter fashion. So Apple's rallies go, in a vertical direction, whereas Google slowly and almost in a boring way rides up. But this still presents you with the opportunity to get into Google. For example, in the beginning of the year, it's giving you this dip. I realize that Google and Amazon are a little bit more of an expensive player. So for somebody like, the average investor, you're not going to buy that many shares. But if you could buy one, it could buy one share. They're going to split eventually. They're going to start doing buybacks. They're going to go above 3,000. These are companies that you buy and you trust and you hold. It's better than buying, $3,000 worth of a very high risk stock. So, for example, you buy an electric vehicle company like Blink, and you buy $3,000 worth of it. You're going to have a higher risk, higher reward investment. But if you're building a solid foundation for your portfolio, which is what you need to start with, you want to have your portfolio loaded with those companies with strong fundamentals before you add the high-risk companies like your Blinks and your Plugs and your Lucids. These are high-risk companies. They are far from being very profitable as Google and Apple will be, and they never will be that profitable ever, because it's just simply impossible for these companies to be as profitable as in Google, as in Amazon. These are, you're talking about companies that are leading our lives. I mean, Google is used every single day of our lives. So, in comparison, you're better off buying $3,000 worth of Google, which is going to give you one share, rather than putting your money in very high risk investments that may not come around, that may lose you all your money. So start by building the strong foundation with companies like these, and then you want to move into the higher risk investments. So you want to have the majority of your portfolio in good companies like this. Now, looking at the next pick for us would be Intel. So the reason why we chose Intel is because Intel is, when we're comparing Intel to AMD, which is its primary competitor. So AMD and Intel are primary competitors. You can see that Intel's performance for the last 2 years has been much, much weaker than AMD's performance. Although Intel has a higher revenue stream, they have been around longer. They're a more trusted name. They are working in the metaverse. They are working on blockchain. They have everything in the bag. They bring in more revenue than AMD. They have more assets than AMD. And not to discount any AMD's future performance, because AMD is also one of our picks as a semiconductor, and so is Nvidia, but it didn't make the list. AMD and Nvidia are still roughly, bringing in less than $10 billion a year in revenue. Whereas, let me double check those numbers. I'm going to go ahead and show you exactly how I got to that. So if we go to Trading View and we're going to go to AMD, for example, AMD, if we're going to go into its financials, you're going to see that AMD income statement here, total revenue, 2020, $10 billion. So when we're comparing that revenue over into Intel's, and you're wondering, and Intel is a much cheaper stock in terms of value on the stock market. Intel is bringing in $78 billion in revenue. Yet it's trading a much lower than AMD. And let's see what the valuation is. So $217 billion valuation for Intel. Let's see what AMD's valuation is. 160. So you're telling me that AMD is valued at 160 and it's only bringing in 10 billion in revenue. Yet Intel is valued at 230, I'm sorry, and it's bringing in $70 billion in revenue. So the numbers just don't add up. So when you see an opportunity like Intel and a company that's trading at a low like it, the market will eventually realize the value of these companies, and all it takes is one positive announcement from the company for them to get back on track into a positive flow. So as I mentioned earlier in the video, to start 2022, try to ignore the companies that rallied as much as they did into 2022. So, from the companies that rallied through November, December, into January of this month, try to ignore those companies, but keep them in mind to add them at a later point this year, because AMD and Nvidia and Apple and Microsoft, they're going to have their cycle again. They're going to go back up, but for the next 3 months to 6 months, you're going to see them come down, and you're going to see your Intels and the companies that have not had the light of day begin to go up. And that's just how money rotates in the stock market, which is why we're saying the stock market is not crashing. We're merely seeing a money rotation. Unfortunately, most people only focus on technology stocks that are very well known. Therefore, they see the market as crashing, but the market is actually giving you an opportunity to be a part of money rotation. Let's see, the next stock for our list is going to be Disney. So Disney is an obvious choice. Disney owns ESPN, they own Fox, they have Disney Plus, their parks are nonstop, they're bringing in nonstop money. Disney is a winner. I mean, my gosh, 2021, look at this performance. Look at this opportunity that they brought you. Disney at these lows is a very attractive company. This is almost like, we already talked about tech, we talked about the FANG stocks, we talked about the opportunity, but when you want to balance a portfolio, you want to go with a company like Disney. You want to have a company like Disney in your portfolio, because when technology looks grim and when things don't look too good for the internet companies, you're going to have a Disney, the broadcast, the network, the parks, a favorite stock in America, a company that America won't let fail. So Disney is a winner. These lows, buying anywhere at these lows is an opportunity in our eyes. Disney is going to move up in the next few years. This is a winning company in our eyes. So Disney, we don't have to explain too much. Uber is also a winner, although Uber is not posting consistent profits yet, but they have posted a quarter or two in the last year, so they're moving in the right direction. Unfortunately, they had a shortage of drivers, but with Uber Eats, Uber as a leisure company in the coming years is only going to grow unless there is something that drastic or tragic that happens to the company. This is a company at this price is one to add as a high risk, high reward investment. You don't want to have as much money in it as you have in Apple or Amazon, but this is a company to consider as a high risk, high reward company that may double, triple in the next coming years, depending on performance. This is one that I would consistently pay attention to quarterly earnings. For Apples and Amazons, I like to pay attention to their yearly performance, whereas Uber's, your Uber, the higher risk companies, you want to pay attention to quarterly earnings. You want to pay attention to any plans they may have. Next pick is Ford. So Ford actually made it to our list last year, and we were around $8. It's been a fantastic year. It's tripled. So a threefold gain on a stock is a fantastic year for us. Ford was an awesome play. We got in because their financials looked much better than GM. They had a stronger balance sheet, yet they were trading at 8, GM around 50. So definitely a big winner. We were very happy with the performance of Ford in the last year. We think it's going to continue pushing into all-time highs. into 30 and above because of their contract with Rivian. They do own part of Rivian Motors, if you don't know, and then also because of the opportunity they're seeing in the electric vehicle market and the infrastructure they already have to build electric vehicles and batteries. So when it comes to EV markets, stop focusing on the new companies because most will fail, and start focusing on the existing companies because they have the money to support the infrastructure to build EV faster than their competitors that are just coming on board. So when we're looking at Ford, you want to find a strong pullback. At this point, the stock has already ran its course. It is indeed seeing a ton of buying, but look for a strong pullback before you get into this one because it is sitting a little too high for my comfortable entry. Next, we have gold, which is actually a mining company. They're sitting at a low. So gold is a fantastic opportunity because inflation stayed around 5 to 7% all of 2021, but in 2022 we're going in with 7% inflation. Gold, however, has underperformed the entire market, which is and we're talking about gold in general, GLD as the actual material, but when we're looking at Bitcoin, that became the new hedge for the market. So instead of buying gold as a hedge, people started buying Bitcoin as a hedge. But gold and silver are still materials that you want to keep in your portfolio because, again, you have to. In the market, it's all about being proactive, not being reactive. So when you have a portfolio and you're building a portfolio, you're looking for a safeguard against the worst case potential for the rest of your portfolio. And so when you have companies like Disney, when you have gold, when you have silver as which is the next thing that's mentioned, these are safe havens that investors will run to in the case of a meltdown in the tech sector or a meltdown in internet companies. And so you always want to have protection in your portfolio, especially when silver and gold are sitting at these lows. I mean, it's not going to cost you much to add these small shares into your account, but they will pay off in the long run. So silver is another top pick. And then I'm not going to get into these guys. I do recommend you check them out. ARK Investments by Kathy Woods. So ARK is mainly focused on innovative tech, everything from your fintech, so financial technology, robotics. They're heavily invested in Tesla. So a lot of people may ask, why didn't Tesla make the list? Simply because Tesla, at the highs that it's sitting, it's not, it just doesn't appeal to me, and you can actually see a very strong bearish engulfing candle forming on the very first week of the year, which is going to send it back down unless this changes. Tesla is more than likely going to stay down for a very good amount of months before gaining market share again. And the number one reason is going to be competitors in the electric vehicle market. So for the longest time, Tesla dominated the electric vehicle market, but not for long. They're going to have competition from GM, from Ford, from Chinese companies, from every single company that's making electric cars now. Tesla is getting market share taken away from them by every single one of those companies. So you have to keep that in mind. If you're an investor in Tesla, realize that Tesla is one of those stocks that runs its course at the start of a new technology, but will be one of the fastest decliners. And of course, Tesla is getting into robotics, so there may be an opportunity there. But when you look at Tesla as a company, you'll realize that they just started making profits. So they're still not at a point in which they are a very profitable company. Google makes $70 billion a year, and Tesla is only at $4 billion at their pre-tax income and net income. It has just entered profitability in 2020. And so when I'm investing in Tesla, I would much rather pick up one of the ARK funds that has Tesla within the index fund rather than pick up Tesla as a sole company, because at these highs, it's just too expensive for the numbers that I'm seeing on the balance sheet. So definitely check out the ARK indexes. I like these specific three indexes, but there are more to choose from. And then, of course, make sure you do your due diligence. Make sure you do your research. These are just companies that I like. Whatever you're into, make sure you understand what you're investing in. If you don't understand it, don't invest in it. That's just simply a rule, because if the company's making announcements and you have no idea what they're talking about, then you may catch yourself in trouble. So make sure you're reviewing, make sure you like what you're investing in, and make sure you're doing your due diligence. Thank you guys for checking in. Don't forget to subscribe and like, and enjoy. Good luck to everybody this year. It's going to be an awesome year.